My name is Peter Harrell, and I'd like to welcome you to this inaugural soft launch episode of Security Economics, my new podcast on the intersection of all things dealing with U.S. national security and economics. We're recording this on Sunday, February 2nd, a day after President Donald Trump announced sweeping new tariffs on Canada and Mexico, as well as on China. And to discuss these breaking developments, I'm thrilled to be joined by my longtime friend and colleague, Brad Setzer, who is the Whitney Shepherdson Senior Fellow at the Council on Foreign Relations, and who has been a longtime expert on economic policy, on trade, and on all things economic. Brad, it is great to have you here this afternoon to talk about these breaking developments.
My pleasure. Glad to start a series, so to speak.
Well, so I want to get into the details of what Trump did yesterday and what we're seeing out of Ottawa and Mexico City to retaliate and how all of this might unfold. But first, I want to start with a very practical question. As I said, it is Sunday afternoon that we're recording this, and these tariffs, if I read the executive orders correctly, will be coming into force just after midnight on Tuesday. And if I think I'm going to buy a car this year, should I be getting out to the dealer this afternoon as soon as we stop recording?
Well, I would say you should be getting to your grocery store this afternoon and stocking up on avocados. If you like blueberries and blackberries and raspberries and strawberries, don't wait. Don't wait a minute. I think if you're looking to buy a car, particularly, frankly, a GM or a Ford or a Chrysler, you better start thinking about whether that car is made in Mexico. And if it is made in Mexico, or less likely Canada, you probably have a week or two because, the cars on the dealer's lot are already going to be in the U.S. There's a certain amount of inventory, and it's going to take a while before the 25% tariff feeds its way through. But you probably don't have a month. So if these things stay on for a long time, you really need to think about buying a car sooner. It's going to raise the cost of American-made cars as well, because the standard car made in the U.S. has a decent amount of Mexican and Canadian parts. The only case where you might not have to worry, and it's an open question, is if you're looking to buy, say, a Hyundai, and say the Korean won sells off hard tonight, because we've just tariffed China. China might let its currency weaken. When China's currency weakens, all of Asia tends to weaken. So you might get a bargain on a Hyundai for a few months. But beyond that, you should move, to be honest.
Okay, so what I hear you saying is on cars, if it's a U.S. marked car, go ahead and buy it now. If I want to take some risk, there might be some sort of currency arbitrage opportunities in the car market.
I'm going to come up
coming up, which of course you're going to comment on. So good to know there might be some arbitrage opportunities if I want to buy a
But the
Hyundai.
serious point is that it is absolutely crazy to be tariffing cars from Mexico, which have a lot of U.S. content. Tariffing cars from Canada that have a lot of U.S. content, raising the cost of producing an American car in the United States, and then not tariffing imported cars with almost no American content from Korea, Japan, and Europe. Ultimately, if these tariffs stay on, you're going to have to broaden the tariffs. It's just sort of self-evident that unless you broaden the tariffs, it's kind of a self-defeating policy.
That's a great point that I'm going to get into in some more detail in a couple of minutes when we talk about where this might go in the future. But I think you really opened the door to let's dig in on what exactly Trump did yesterday. So what Trump did yesterday, as I read it, is he signed 3 different executive orders. One of which imposes a 25% tariff on substantially all products made in Canada, with the exception of energy products, which are still tariffed just at 10%. Signed an executive order imposing a 25% tariff on substantially all products made in Mexico. That appears to include Mexican energy. Mexican energy gets a 25% rate as opposed to the 10% rate that is applying to Canadian energy. And then he imposed a 10% tariff on pretty much every import that the U.S. brings in from China. That 10% is additive to the tariffs he imposed on China during his first term, where he tariffed a number of Chinese products at different rates, many at 25%, some at 7.5%, and some at 0%. I thought it was interesting that the 10% on China applies to everything. So I think notably, for example, that is now a 10% rate on various consumer electronics like laptops and phones that Trump had not tariffed during his first term trade war with China. And as I said earlier, these tariffs are all coming into force Tuesday morning. As of now, it doesn't look like there's an exclusions process on them for a way for kind of manufacturers or importers to come in to get product by product exclusions. So we'll have to see if Trump relents and starts a exclusions process in the coming days or weeks. And as I've looked at this, it does seem to be a dramatic action that is really substantially broader in scope and in scale and frankly in speed than what we saw Trump do during his first term. But Brad, I'm curious to hear from you. What surprised you most about what we saw yesterday, particularly given that Trump had been signaling for some time now that he was going to be moving towards various trade wars with U.S. trading partners?
Well, I think yesterday maybe I wasn't that surprised because this has sort of been telegraphed. I was actually expecting there to be a last-minute delay up until Wednesday or Thursday because it just, if your goal is to negotiate, you need to give people time to negotiate and you need to have your negotiators in place. So I was sort of thinking that it wasn't going to happen on February 1st. Obviously wrong. And I think more generally, my theory of what the Trump administration would do has been overturned. My operating thesis was that the Trump administration would do something that I would consider extremely aggressive, but a bit more logical. That is, start with very aggressive actions against China, do something like a 232 on auto trade, which would give you a it takes longer. It's a process, but it would give you the basis for negotiating on autos with all your trading partners, and then renegotiate the USMCA, the Trump trade deal, by the way, next year, focusing on kind of Mexico's imports of Chinese cars, strengthening North America, making sure that Mexico isn't a conduit for embedded Chinese content. He obviously did nothing along those lines. He did it almost the reverse. He started off with Mexico and Canada with an almost, the 10% tariff on China is significant for precisely the reason you mentioned, that it covers Apple for the first time. I mean, Trump called Tim Cook Tim Apple, and he gave him effectively an exclusion in his first term. Covers laptops. Fair enough. I guess if you're going to cover iPhones, you should cover laptops. But, you enter into all these strange second-order effects when you're also putting tariffs on Mexico. We have 25% tariffs on desktop computers from China. That was part of the first Trump trade war, but not on Mexico. So now we're getting most of our desktops from Mexico. So you just put a 25% tariff on desktop computers from Mexico. And now the obvious substitute for a desktop is a laptop, and that's going to come from China. It's only going to be tariffed at 10%. So I think there's sort of enormous, I would say, surprise in a bigger sense that this targeted Mexico and Canada. Even more surprised that Trump's rhetoric has been, if anything, more focused on Canada than on Mexico. And Canada is, of the various trade partners we have, in a lot of ways, the best one. We have the most balanced trade with Canada. We have a manufacturing surplus with Canada. Canada actually sells us their oil at a discount because it's trapped oil. There just isn't a substantive case that Canada has been a bad trade partner. Yet Canada's at the front in the rhetorical sense. You mentioned the 3 executive orders. You left out that this was all done under IEEPA, the sanctions authority, the International Emergency Economic Powers Act. And so to use your, in a sense, most powerful tool, the tool you use for sanctions, the tool you use generally against your geopolitical rivals, against a NATO ally to your north, where you have basically the most balanced trading relationship that you have with any major economy in the world. That was just outside the realm of conceivable 6 weeks ago.
Well, I'm glad you brought up that point about the basis of these tariffs. As you noted, Brad, they are under the International Emergency Economic Powers Act, or IEPA, which has been used dozens of times for sanctions around the world. I think, including most recently, it's been the basis for most of the Biden administration sanctions on Russia after Russia invaded Ukraine in 2022. This is the first time that IEPA has been used for tariffs since IEPA was passed in 1977. What was interesting to me reading the executive orders is that, because IEPA is a national security statute, in the executive orders, the basis of this really is the fentanyl crisis. Trump has sort of identified the emergency the U.S. faces around fentanyl and cites the kind of need to put pressure on Canada, Mexico, and China to address fentanyl as kind of the legal basis or the policy rationale of these tariffs. I would say both prior to yesterday and in the not quite 24 hours since these tariffs come out, we've also seen Trump talk quite a bit about how unfair the trade flows are with these countries, how we're getting ripped off. Brad, what do you think Trump is trying to achieve with these tariffs? Like, what do you think he actually wants with these tariffs? And is he looking to negotiate over fentanyl? Is he looking to negotiate over trade policy? Like, what's his goal here?
Well, I think in my answer to your previous question about have I been surprised, I kind of have betrayed the fact that I no longer feel like I'm inside Trump's head. Maybe I'm inside Bob Lighthizer head. I sort of have a sense of what Trump's first-term trade representative cares about, the kind of actions that he would recommend. But he's not part of this team. And Trump, on one level, if you listen to the kind of conventional views that were put forward, by representatives of the Trump administration, by Trump's Treasury Secretary Scott Bessent, you would say, okay, this is just the unique Trump negotiating style. Escalate to de-escalate. You always start a negotiation by destabilizing the other side. You're unpredictable and you're big. You're aggressive. So I think that's kind of the conventional view, that this is, bringing a bazooka to a knife fight. But since the stakes are more a knife fight, particularly with Canada, where there isn't that much fentanyl coming across the border, there should be a deal. It should be a little bit like the threatened use of tariffs against Colombia over, kind of the treatment of Colombians on a military flight. On the other hand, if you just take Trump at his word, if you just look at what he's posted on Truth Social, and these are, one assumes, things that come straight from the president. I mean, these are written in the tone of the president. We've both been staffers. Staffers write in a certain way. Staffers don't write like Donald.
I think his aides would not use capitalization quite the way Donald Trump uses capitalization. I take your point, Brad.
Yeah. And your aides are not going to suggest that Canada become the 51st state. That generally gets struck out of any presidential communication. And his stated objectives are, well, you're just ripping us off on trade. Fentanyl's almost like non-existent in some of his statements. And since you've been ripping us off on trade for so long and we've been subsidizing for you for so long, why don't you solve this problem by becoming the 51st state if you're Canada? That doesn't suggest you're looking for a quick, easy deal, because there's no quick, easy deal that solves the trade deficit with Canada, because we haven't actually identified anything substantive that we would want that would materially change the trade deficit. I mean, some of his more rational advisors bring up the longstanding concerns about Canadian treatment of U.S. dairy exports. But that's, $1 billion. It's not a big enough sector to move the needle. And it's actually politically very difficult because it affects the interests of the Quebecois cheese lobby. in an election year in Canada. So it's not going to be an easy source of a deal in conventional trade terms. So, and then if you look at the broader statements that Trump has put out, he really seems more interested in the tariffs than in a deal. He wants, it's basically come here, come produce in America. We've been running trade deficits for too long. We built up too much external debt. Points I sort of broadly kind of agree with. But then he says it doesn't matter how much the cost will be in the short run. It's going to be great in the long run. This will make America great again. That is not the rhetoric of someone who's looking for an easy deal. It's the rhetoric of someone who wants to put tariffs on and keep them on. So I frankly have no clue.
I hope we do get some more clarity over the coming weeks, although I have to be honest, I'm kind of with you, and I think that if you're looking at this from the perspective of Ottawa or Mexico City, it's just not clear what you might offer in order to negotiate these away.
If you take the president seriously, the only offer that will satisfy him is an application to join the United States of America.
Yeah, this is true. This is true. But fair point, Brad.
Traditionally, you would think Mitch McConnell would block that because he'd be worried about how that would affect the Republican majority. But Mitch is not there, so who knows?
That's a great point, Brad. I want to talk about the economics of this in just a moment. But before we get into the economics, I actually want to talk a little bit about what you think Ottawa and Mexico City are going to do to retaliate here, which obviously will then play into the economics of how this plays out over the coming months, assuming the tariffs remain. So we have some announcements out of Ottawa last night and this morning. They are planning to impose tariffs on about 160 billion Canadian, so about 110 billion US. It's what struck me looking at the Canadian announcement is that it is noticeably more targeted than what the Trump administration did. It is targeting kind of particular categories of American products where, it looks to me the Canadians think they can find alternatives. So it's like home appliances and whiskey and various other, kind of substitutable products. The Canadians are also, I see in the press, talking about using non-tariff measure retaliations. We also saw Freeland, who's running for prime minister up in Canada, it's an election year, talking about targeting some of the business people who are close to President Trump. So she's talked about going hard against Tesla in particular, but I didn't actually see that in the retaliatory measures announced today. And then down in Mexico, Claudia Sheinbaum has talked about implementing Plan B, which appears to include retaliatory tariffs, but at least as of we're recording this, I had not seen specific Mexican retaliatory measures. What are you expecting we're going to see coming into force over the next couple of weeks and months out of Mexico and out of Canada in retaliation?
Well, I think the key thing to understand is that Canada and Mexico are substantially smaller economies than the U.S. They're both like $2 trillion economies. So the first approximation were a $30 trillion economy, and they're both, because they are small and close to a big economy like the U.S. They, as a share of their economy, they trade a lot with the U.S. So it seems clear that the Canadians, and I would assume the Mexicans, have chosen to adopt what I would call a more conventional retaliatory package. So what is it more conventional? A conventional retaliatory package, you look for those goods which you can tariff, where you think you're going to impose more harm on the exporting country, on your trading partner, than you're going to impose on your own consumer or your own producer. So therefore, you would not want to tariff auto parts coming from the U.S. to Canada, because that would raise the cost of auto production in Canada. But you would tariff a lot more final consumer goods. I think eventually you'll probably end up tariffing electric vehicles for that reason. Why wouldn't you choose a target that is a final kind of a luxury consumer good, the way Teslas are priced? Of course, you're going to also hit some of the Fords and the GMs that are going to be a little bit more complicated for you. But look, it's a conventional but aggressive retaliatory list. I would say it actually looks pretty well thought out. It leaves you room to escalate because Trump has also threatened to raise the tariffs more if Canada puts tariffs on us, or if Mexico puts tariffs on us. They tranched it, so there's I think 20 billion US that comes into effect this week, and then the bulk comes into effect in 2 or 3 weeks. So it's set up to give some time to negotiate, and it's set up to be, I would say, sustainable in the sense that you know you're going to import a lot more cognac and not import whiskey from the U.S. You're going to buy European appliances, not appliances that are made in the U.S. You may actually be able to still buy a lot of appliances made in Mexico. And if you're Canada, you may get those cheap because of some of the dislocations created by the other trade wars, or that the U.S. tariffs. I think Mexico probably will emulate the Canadian approach, although they have, as you said, they haven't specified exactly what they're going to do. But if I would think that would be the sensible way. I think you could think of it as, if you think of if 100 billion of tariffs come on goods coming into Canada, it's like a tariff list of about 4% of Canada's GDP. So as a share of GDP, it's actually commensurate. Just because Canada, there's so much more two-way trade. I think there's going to be some, we'll see what China does. China may play it cool because they may think that, well, this is only a tariff on fentanyl. We can do a deal on fentanyl. We're not going to go too aggressive. They've suggested that they're going to appeal to the WTO, which is, frankly, what you do when you don't want to take immediate action. So they may play for a deal at a Xi-Trump summit and may play for time because, the shock here is that we're tariffing Canada more aggressively than China. And then they have, while Mexico's currency and Canada's currency are free-floating currencies, they're going to react when the markets open in response to the estimated effects of these tariffs, how it's going to impact Canada's economy, so forth and so on. Canada's exchange rate's a policy tool. China's exchange rate's a policy tool. So China will make a decision about whether they want their currency, which had actually been appreciating a little bit with the lack of aggressive action on China so far in Trump's second term, whether they want to start a process of letting their currency weaken, which is basically a way of saying, okay, we're going to sell less to the U.S., we'll sell more to the rest of the world. And that deflects the cost onto the rest of the world. So I think we're going to see a range of responses. I would say, to be blunt, the Canadians have thought this one through probably more than our president has.
Well, that actually brings me to the next question, Brad, that I wanted to hear your views on. You have, both on online social media podcasts and through some of your blogging with the Council on Foreign Relations, you've done quite a bit of analysis over the last couple of days and going back for a couple of weeks and months about what some of the economic impacts of this kind of a trade war might be. What's it going to do macroeconomically? How much currency adjustment are we going to see? Be interested if you could just walk us through for a couple of minutes about what, assuming the tariffs remain in place and the retaliation plays out about the way you expect it to, obviously big assumptions because we don't know if they'll fully remain in place or where the deal or lawsuits might go. But how would you expect this to play through economically if things do remain broadly in place?
So let me start with a sort of background observation that informs the analysis, which is that as long as these, at least in theory, are temporary, your incentives as a firm to make permanent changes to your supply chains, to your location of production, are going to be a little bit limited. You're going to want to wait and see, even if that means paying a little bit of cost now before you take a more costly decision to relocate production. And I think it's all the more true now because there's no clear safe haven from future Trump tariff threats. If he's upset about the bilateral deficit with Canada, your only safe locations of production are those countries where there is no bilateral trade deficit, which is basically Brazil and Australia. You can't go to Vietnam. You certainly can't go to Mexico. You can't go to China. You can't go to Japan. You can't go to Taiwan. You can't go to Europe. So you're kind of, your choices are limited. You can come to the U.S., but the U.S., the dollar is already very, very, very strong, and there's a big cost disincentive at current exchange rates to tearing up your supply chains and biting the bullet and coming to the U.S. if this is going to just go away in a week or 2 weeks or 2 months or 3 months. So I think because of that uncertainty, we're likely going to see the cost of the tariff you're going to see the cost to consumers, and you're going to see the cost to producers who use Canadian and Mexican parts. You're not going to see the benefit of relocation of production because that takes time. Most of these sectors are sectors where there's not a ton of spare capacity in the U.S., particularly not a ton of spare capacity if you think that the spare capacity in the auto sector uses Mexican and Canadian parts, which have gone up in price. So therefore, you just kind of, to my mind, the right approach, the way to start thinking about this is to look at the what I call it, the just pay it cost of the tariffs. So our imports from Canada and Mexico are about 3.2% of our GDP. Take away oil, let's just throw that out because that was tossed it down. Gets it down to a little under 3% of GDP. And we'll set aside China for the moment. You do the 25% tariff, and if you actually just pay it, just bear the extra cost, that's basically a 75 basis point or 3/4 of a percentage point loss of consumer purchasing power and loss of purchaser spending power because some of the auto guys are going to absorb it initially, then pass it on. That is twice the size of the trade action we took against China over the full first Trump term. And that was much more telegraphed. So I think, you're probably going to be looking at an impact that's pretty close to that 3/4 of a percentage point of GDP in the short run. I think most models will give you a somewhat smaller effect. Now, the possible offset is the exchange rate and the adjustment in the exchange rate. That will, if the fall in the Canadian dollar and the Mexican peso is significant, and if you use the analysis of our own Treasury Secretary, Scott Bessent, he says that, a 10% move on tariffs should lead to a 4% move in the currency. So a 25% move should lead to a 10% fall in the exchange rate. And so then you say, it's only a 15 percentage point hike in the cost Americans face. And you can adjust that because sometimes exchange rate moves aren't fully passed on, da-da-da-da-da. But then if you're having this adjustment in the exchange rate, it doesn't actually matter that Canada and Mexico haven't targeted all U.S. exports because all U.S. exports become more expensive. And we do export like 2.5% of GDP to Canada and Mexico. This is not China. There's two-way trade. So we're going to feel some of the effects of the appreciation of the dollar, some of the effects of the targeted retaliation. So I am inclined to think that we're seeing a hit to the U.S. economy of at least a percentage point and perhaps 3/4 of a point. Again, over negotiating objectives that I think at best can say have been poorly defined, and our trading partners don't actually know what we want, so they don't know what we can give. And then I think there's an added cost, to be honest. USMCA was Trump's own trade deal. It was supposed to be the model of a trading arrangement that Donald J. Trump liked, that was fair. And if your first actions effectively tear up this trading arrangement, you can put Humpty Dumpty back together again, but the trust, the expectation that North America will remain a single integrated market, I think has probably gone away. If we create a recession in Canada over this, a Trump recession, will Canada want to remain as integrated with the U.S. economy as it has been? My guess is no, actually. And yes, they will negotiate. Yes, they will strike some sort of deal. Yes, they will try to put USMCA back together again. But they almost have to diversify. They have to build pipelines to get their trapped oil to the coast. Do they really want to be as integrated into the North American auto industry as they are now? Or do they want to try to integrate more with Europe or some other trading partner? So I think there's going to be some long-run effects, almost independent of whether we get the full short-run effect.
I think you raise a really important point, Brad, about the confidence in deals and in negotiations here. I think that if I were sitting in one of them, the capital of one of America's trading partners, I would have very low confidence that any deal I strike with Trump over the next couple of years is going to prove durable and stick. Because as you note, he's sort of maximally tariffing the partners who were the members of his signature trade deal from his first term in office that actually only came into force in early 2020. So it's been less than 5 years, or maybe basically exactly 5 years into force this month, and was set to be renewed in a more or renegotiated in a more orderly process just next year. So I do think that while partners are clearly going to be looking for tactical off ramps and are going to want to get out from tariffs, I just think it's going to be hard for partners to want to strike something that they see as a durable deal here, because they're just going to be skeptical that it is durable. I appreciate, Brad, also your comments about actually some quite significant economic impacts. And we don't want to overstate those. U.S. is obviously 70% services economy. This isn't probably, I don't hear you saying this is going to cause a tipping into a major recession kind of thing, but clearly quite significant economic impacts. And one of the things...
I'll even be a bit bolder. Like, if you do this, and if this is just the appetizer, and it's followed by tariffs on Europe, and it's followed by 10% across the board forever, and it's followed, how are you going to tariff Europe, Canada, and Mexico, and not tariff Korea and Japan and their cars? If you do the maximalist trade agenda that Trump has put forward, you would be in the realm of possibly triggering a self-inflicted recession. I don't think we're there on the basis of what has been announced, but the trajectory of maximalism could get you there, which is shocking. I mean, I generally have the view that people overestimate the economic impact of a lot of trade deals and a lot of trade action, just for the reasons you outlined. We're a service economy, we're a domestic economy, we basically sell services to each other, and we imports are whatever, 10, 11% of GDP. But when you do this level of disruption, then you're getting into the economics of this one move. It's about equal to the impact of a 10% across the board tariff. So we're getting close. We're getting into that realm where you could see some tipping points.
So that's a really good point, Brad, about, we should be reading these actions yesterday, not just for what they are, but also what they signal about where Trump may take U.S. trade policy over the coming couple of months. He has obviously said publicly just in the last week he is planning to impose tariffs on the European Union as well. He's also been talking about sectoral tariffs. He's talked up tariffs on semiconductors, on pharmaceuticals, and on a couple of other products. So I do think you make a very fair point of this is both quite maximalist against Canada and Mexico, and also signals that we probably are going to see a fairly maximalist trade agenda play out against other trading partners over the coming months. If you were sitting in Brussels, or if you were sitting in Tokyo, how would you be interpreting what Trump has done, and what would you be getting ready for that might be coming your way?
Well, if I were in Tokyo, I would be trying my best to summon the ghost of Prime Minister Abe, so that
golfing. So you'd be taking golf lessons, is what you're saying, Brad.
I would be seeing how much I could amp up my defense budget, and I would be basically praying that Trump can, for whatever reason. Japan has always gotten, it was Abe, of course, in his first term, but Japan has always gotten off relatively lightly. If Trump cares about auto trade, and he seems to, Japan's still a pretty big auto exporter to the U.S. They've never really gotten whacked. the difficulty Japan faces is they kind of gave Trump what he wanted on agricultural trade in his first term. There aren't a ton of easy concessions the Japanese can make because they've already kind of made them. The yen's at 150, which is a very weak level. The natural incentive is to actually produce cars in Japan and sell them to the U.S. You're going to be willing to negotiate. If I'm Japan, I'm willing to negotiate voluntary export restraints. I'm willing to kind of appease, in part because Japan's exports to the U.S. haven't been growing that much. The real growth has come from Mexico, from Korea, actually from Germany too. Germany's done quite well selling electric vehicles to the U.S. But Korea has been the growth from Korea has been a lot more than the growth from Japan. So capping your growth, doing those kinds of deals, I'd be getting ready for that. And then frankly, hey, our pattern with trade of Japan is a little bit like our pattern of trade with China. We don't sell that many manufacturers to Japan. They do buy some agricultural goods. And I would be getting ready to kind of more or less say, okay, you whack our autos, we're going to zero out to the best of our ability our imports of your agricultural goods. Good luck with your trade war with China if we can't sell agricultural goods to Japan. That'd be kind of what I would be thinking about. And I'd also be like, frankly, hey, are you going to really tariff parts going to Boeing? I mean, Boeing's not in a strong position to begin with, and Boeing gets a lot of components from Japan. I mean, if you're Trump, short term, long run, why do we need anything from Japan? Wings, we should be making them at home, whatever. If I'm Europe, I'm looking at the Canadians. Europe does tend to retaliate. I think Europe knows that they are on the list. They knew there was going to be tariffs over their digital services taxes or some of the tax stuff. They knew that it was likely Trump was going to go after autos. He's put them on notice around pharmaceuticals. Europe, I think, is ready to respond in kind. They're also, I think, probably willing to negotiate if there is a deal. And I think the hard part is that it's unclear at this stage if Trump prefers a deal to tariffs. But I mean, the Europeans, you're going to be getting your list ready. You have a choice, a little bit like our choice with Canadian energy. Europe imports a lot of U.S. natural gas, and that's not a natural thing to tariff. So you're going to be looking at, I would think they'd be looking really closely at those Canadian lists. And in a sense, the natural alternative to selling whiskey to Canada is to sell it to Europe. So in a full-on trade war with Canada, the strength of some of Europe's retaliatory some narrow ones may go up, but they're going to do a balance between negotiating and using their trade tools to respond. What's frustrating to me, and I think to you, because we were both in the Biden administration, we really wanted a bigger, bolder response from Europe to our initiatives when we first went into office. That was kind of our goal. We wanted to work together to take on China and China's industrial policies, which were clearly hurting both of our economies in a stronger, more substantive, and more coordinated way. And we didn't really get a lot of cooperation on that agenda in the first year. We got some things, hey, we got a statement on the Boeing Airbus deal that we want to cooperate against China, but there wasn't a lot there yet. I think Europe has moved, and I think Europe would actually be willing at this point because the China shock right now, the second China shock's real. It's hitting Germany. It's hitting Germany hard. European politics have shifted. There is much more willingness to be bold and aggressive, take bold and aggressive measures against China. If they had confidence that would limit Trump's trade actions directly against them. But in a context where you're going to be just whacked in the way Canada is whacked potentially, no cooperation is really possible, sadly.
Yeah, I think that may be what we're going to see. I mean, it does not look like Trump's sort of asking for concessions on China out of the Canadians and the Mexicans. I mean, none of that came up at all. As you say, it's really just bilateral trade deficit issues with maybe a little bit of fentanyl thrown in for legal reasons, if nothing else.
I actually really feel frustrated by this because I feel like the Europeans were finally ready. So I think we're missing an opportunity.
Well, I want to talk as we get near the end of our interview. I want to talk a little bit about the pushback we are beginning to see. I mean, I have to say, when I look at kind of the statements coming out of trade associations and others, we are seeing trade groups and companies that want to stay on Donald Trump's good side. You can sort of see, even as trade associations and companies criticize these specific tariffs, are trying to be polite to the administration and talking about the importance of getting economic policy right. Nonetheless, we are beginning to see some clear signs of pushback. The home builders have come out and said this is going to increase housing construction costs. The refiners have come out and said this is going to increase potential gasoline energy prices in the Midwest and along the Gulf Coast. Interestingly, we've also seen at least a couple of unions, both the auto workers and the steel workers, not precisely full out oppose them, but express some skepticism and say they don't want to be pawns and see their manufacturing be used as pawns in trade wars that aren't really necessarily designed about protecting their interests. So I think we are beginning to see some rhetorical pushback. I also, as a trade lawyer, am interested in whether we'll see legal pushback. I've argued in some recent writing that I think there are credible arguments that IEEPA does not have or does not include the legal authority to impose tariffs. And I'll be quite interested to see if any trade associations or companies will bring suit in the coming days to try to challenge the legal authority on which President Trump has implemented these tariffs. I should caveat that by saying I think that even if the courts strike down these tariffs under IEEPA, Trump does have other trade authorities that he could use quite expansively to impose tariffs on Canada and Mexico. Those other trade authorities would just require detailed investigations and a little bit of tariff notice and comment rulemaking process and things like that. So it would slow these tariffs down and increase regulatory burden, but probably wouldn't. Overturning these tariffs under IEEPA probably wouldn't a year from now mean there are no tariffs on Canada and Mexico if Trump remains committed to them. But I think we are beginning to see the rhetorical pushback. Obviously, we're seeing industry, leaders saying we're going to evaluate our options here. What do you sort of expect by way of pushback out of U.S. stakeholders over the next couple of weeks?
Well, I agree with you that it's remarkable how broad the pushback is, even if it is, as you said, measured in the sense that people recognize they're going to have to work with a Trump administration for the next 4 years. I think it is indeed striking that the auto workers and the steel workers are not fully on board with this. I think that's a sign that frankly, Trump overreached. They probably would have been on board with tough actions against Mexico. But they are not on board with tough actions on Canada that are independently done from any assessment of how they impact the U.S. auto industry. I mean, there's some estimates that suggest that this kind of trade action would lead to a reduction in U.S. auto production because we're raising the cost of U.S. auto production relative to Japanese, Korean. We're also just raising the cost to American consumers, so people will wait longer to buy cars. May lead to a cut in production of 1 million cars a year, which means layoffs. I don't think the auto workers signed up for a trade policy that would increase layoffs in auto plants in Michigan.
I can't imagine that is, in fact, what they want here.
Right. And so, that's a sign to me that this is really an overreach in trade terms. It has no support, broadly speaking. The question is, other than the challenge to the use of IEEPA to do this, which I think is real, I'm not a lawyer. I think your arguments are pretty persuasive. I think the arguments that you can't use IEEPA to do an across-the-board tariff, except within the narrow 6 months balance of payments window, I think those are very persuasive, because that does seem like a usurpation of congressional authority to raise tax and tariffs. And it also, I'm not sure you can quite sell a national emergency that broadly. But the basic problem is that,
I don't know, there were 19 kilos of fentanyl seized at the Canadian border last year, according to the New York Times.
So-
You don't think that's a national emergency?
I hate to say it, but no. But I mean, that gets to the problem is like, IEEPA is set up to give enormous discretion to the executive to respond to real international economic emergencies or real national security threats. So there's to my knowledge, there's no proportionality test. That is just basically left to the discretion of the executive. It has been used, I think, despite all the talk about sanctions overreach, it's broadly been used up till now in a fairly responsible way. We've sanctioned Iran, we've sanctioned Russia, we haven't sanctioned Denmark or Canada. So I do think that there is a potential legal challenge to IEEPA, but it's, in general, the courts give deference to the executive on matters of national security and a national emergency. So we'll see. Other than that, it's hard to push back in an effective way. You can try to build support on the Hill to rein in the president's tariffing authority. So you need some Republicans to break from their coalition. Are they willing to do that before you've done budget reconciliation and tax cuts? Don't know. That'll be a function of how powerful the reaction is on the part of workers, businesses, probably particularly businesses, how much blowback this has from the business communities in their home states. But then it's a hard threshold to oppose a newly elected president who's vengeful and can primary you. And then beyond that, I think we're going to see the reaction in the market. And that's where it gets a little interesting. Trump historically has said he has cared about the stock market reaction. Some of his tweets have said he doesn't care about the stock market reaction anymore. And strangely enough, the stock market still, by and large, doesn't believe these things are going to stick. And you don't want to sell GM and Ford tomorrow if on Friday there's going to be a new deal and these tariffs are off the table. So the fact that there isn't clarity is for now lending itself to sort of an optimism on the part of a lot of equity investors that these tariffs won't be around, and so therefore you shouldn't overreact. And since if there's not an overreaction, that kind of takes away one of the brakes on Trump's action. So,
I think that's a really interesting point. I mean, because if you'd asked me a week ago, I would have said one of the constraints on Trump actually following through with a 25%, across the board tariff on Mexico and Canada that really is 25% across the board right away, as opposed to some Swiss cheese, kind of contraption that is tough on paper but not in implementation, is the market reaction. That he would be not want to see a 3 to 5% decline in the stock market, on news of that. But you make a very fair point that as long as equity investors think, maybe there's a deal here, or maybe this isn't actually going to be as bad or as durable as it looks, we might actually see a more muted reaction in the coming couple of days than I would have thought anyway a week ago.
Yeah, I mean, we don't know. We'll see how the markets react. They weren't going crazy with the increasing probability of this kind of action last week. But the full announcements didn't come until after the markets closed. It takes time to digest. But to me, there's a little bit of this is sort of a strange analogy, but as I worked at the Treasury for a long time, the markets didn't tend to sell off on a debt ceiling crisis, which always kind of seemed puzzling to people who were inside the market. But the operating assumption was that we would never be so crazy as to default on our debt. So therefore, why would the debt sell off? If you actually went over the cliff, the assumption was in the market that we would cut other spending and stay current on our bonds, in which case the bonds should rally because you've thrown the economy into a recession, Fed has to lower rates, da-da-da-da-da. And I think there's an element of that. The assumption has been that this is such a disproportionate tariff threat to the underlying issue, especially vis-a-vis Canada, that there's no probability that this will actually stick for more than a couple of weeks. And so there may be a more lagged reaction if that assumption doesn't prove to be true. We'll find out.
Well, last question for you, Brad, and I really appreciate the time you've spent on a Sunday afternoon with me, looking at what we've seen over the last 24 hours and thinking about what we might see, not just with respect to Canada and Mexico, but as we talked about Japan, European Union, other trading partners in the weeks to come. If you were giving advice to a Fortune 100 CEO or corporate board tomorrow, when you get into the office at 6 a.m. and start, preparing the briefings for a morning management committee meeting, what would you be advising that companies should be thinking about and doing in response to this kind of an announcement?
Look, I mean, I would say, first of all, I am not known for someone who's going to be at a 6 a.m. management meeting, which is why I am in the think tank world.
This is why you're at CFR. I mean, we get it. But, if you were giving some advice this afternoon to somebody else who's going to wake up at 5 a.m., yeah.
Look, I mean, you get on the phone with your senators, your House members, let people know precisely how this is going to impact your company, your industry. Try to build pressure to take this off. Play the rational game. Other than that, I honestly think you just have to wait. Why? There is a reasonable probability. It's hard to assess the probability, but there's a reasonable probability that this actually is just about fentanyl and a tighter border on the south, and that 3 months from now, we're in a more normal trade war with Europe and China, in which case, hey, Mexico's where you want to be. You don't want to disrupt. You're not going to, if you're a refiner in the Midwest or on the Gulf Coast that's relying on heavy Canadian oil, you don't need to rejigger your entire refining operations to use sweet light and sell different, you produce different quantities of different refined products. You have to adjust the cattle. It does take some investment. You don't need to make that investment. The current system where we export sweet light and we import heavy from Canada will go on. No, it's just a big show, but you don't need to make costly decisions that you may regret just because there was a brief blow up with extremely heavy tariffs on our closest trade partners. On the other hand, if this is real, if this is the beginning of the unraveling of the integrated North American market, and if this is the beginning of tariffs on pretty much all the final products that come to the U.S. from Asia, you have to make a decision. Trump's not wrong there. You have to make a decision about whether you're going to tear up your supply chains that rely on imports and fully localize in the United States. But to do that, if that's not absolutely necessary at a time when the dollar, as I mentioned earlier, is very strong, the standard market incentives are telling you want to keep your production outside the United States. For some of the pharmaceutical companies, it means tearing up your tax structure too, because you're only producing in Ireland to avoid U.S. tax. Let's be honest. It's not to lower your cost. So you, in a sense, I think you need certainty before you can make a permanent decision that will have an impact on your company for the next 10 years. Because once you build a factory in location A, it's very hard to move that factory to location B. Once you design a product to use a part that's coming from Mexico, it's hard to substitute out of that part. That part is optimized for your supply chain. So I think you're in a difficult position because you don't know where the safe havens are apart from the United States. And the U.S. is expensive. And if all the 10% of GDP that we import, excluding petrol, has to come and be produced in the U.S., that's going to bid up. We don't have workers off the shelf that are trained and ready to do that kind of level of manufacturing. So I think you're kind of caught in a bind until there's a bit more clarity. So I think there's going to be a lot of pressure on your DC team, so to speak, to put pressure on Republicans, to put pressure on the president, and you hope that works because if this is a permanent shift, it's going to be really quite costly. And hey, I'm actually in favor of making more pharmaceuticals in the United States. I think we should get rid of the pro-offshoring parts of our tax code. I think we do need to invest more. We need a CHIPS Act for generic pharma. I'm a believer in the importance of U.S. manufacturing in strategic sectors. I'm a believer in countering Chinese industrial policy. I believe China's macroeconomic policies impose large costs on the rest of the world. But I'm not against all trade. And if we're going to go from a world where we try to make rational assessments of what sectors are important for our national security and our economic security, to a world where we're just ending trade, those are different worlds, even if some of the tools overlap. So I think that's going to give you plenty to talk about. But my fear is, hey, this economic security and economics as national security paradigm is kind of going to maybe get ripped up in favor of the only economic security is full production in the U.S. and no trade, which is a radical shift.
Well, Brad, I think that's a terrific note to leave this on. Thank you so much for joining us this afternoon. It's a Sunday afternoon. Particularly appreciate it. And thank you, Brad Setzer, Whitney Shepherdson, Senior Fellow at CFR. Thanks for joining this afternoon.
Oh, yeah, thanks for having me, Peter.
And that's a wrap. This is Peter Harrell, host of the forthcoming Security Economics podcast. I hope you enjoyed this special Sunday, February 2nd episode with CFR Senior Fellow Brad Setzer as we discussed the major trade actions that President Donald Trump launched yesterday, Saturday, and where this might be going in the weeks and months to come.